Hello, friends. Um, Here today to give you a brief demonstration of DeFi in crypto. First, my general disclosure statement. This content is for informational and educational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Nothing contained here constitutes a solicitation or recommendation, endorsement, or offer to buy or sell securities or other financial instrument whatsoever by the author, presenter, or other associated parties for the content being provided. Please do your own due diligence and seek proper counsel. I'm here today to present because of the fact that I see a lot of FUD about crypto and how it's a scam. I'm here today to show you how a lot of this stuff works and, why people think it's a scam and all that other fun stuff, right? Well, so first of all, I guess I should show you a platform, one of my favorites called Sushi. I've been in sushi for a long time. Sushi was an incentivized protocol that basically paid people in a token to provide liquidity on their platform, right? Um, and so that way people could swap from one currency to the other, like so, right? And so people would use these and provide liquidity, and they'd get these tokens. But the problem is over time, those tokens would sell off. So if we went to go look at something like CoinGecko real quick, we would see that most of these tokens were inflationary, right? Because they added the supply. There was a max supply of 250 million of sushi. Currently, a large portion of it's been distributed already at 192 million. But because of that, over time, from inflation of the supply of the token value has fallen, and it's fallen significantly. Right. This is the early demand, interest in the platform, and then slowly over time, the dilution of the token. Um, so, because of that, a platform such as Beefy came out. And what Beefy does is rather than giving you a platform token, it sells off that platform token to buy more of the underlying assets. And Beefy has been working across multiple blockchains. All right. Now, what you have to realize is that yes, it uses other platforms for its liquidity, right? And it's taking those platform tokens and then selling it off, like I said, for more of the underlying assets. Realize that a lot of times the APY that you're seeing, as you can see, my average APY is 9.48%, which is not bad. But what you have to realize, and this fluctuates, right? It fluctuates based off the volatility, but it also fluctuates based off of the inflationary supply of the underlying assets. In this case, you're trading Bitcoin for Bitcoin, two derivatives of Bitcoin, and it's making 5.44%. So you're probably relatively safe there because you're trading two alike assets, right? But now, if I were to go through and I would look at some of my other platform tokens, in this case, you're trading like right here, OP versus USDC. USDC being a stable coin that's pegged and backed by the dollar against OP, which is a newer token for the Optimism chain. And you'll see that it's 64%. Well, if we go look at Optimism right now, which is OP, right? Let's go look that up. We type in OP for Optimism. We're going to see that the total supply here of Optimism is something like 4 billion, right? But the current circulating supply is only 214 million. So we know that there's a large amount of inflation that's coming into the system for that token. And so because of that, we're aware that the high APY in this case is associated with the inflation of the token. It's very similar to how our inflation that we see on a daily basis is often uh, correlated with the inflation of the dollar. Our inflation that we experience going to the store is actually a debasement of our currency. Even though we don't see it in terms of dollars because the dollars are pegged, we've actually lost something like 98% of our value over the last few decades in purchasing power of the dollar. And it's that erosion of the dollar's purchasing power that gives us our inflation, and that realistically, a lot of times over time, the reason why assets go up in value is, aside from company growth, is from dollar debasement. And so once you understand some of the economics behind that, you can start to understand some of the tokenomics. And this is actually crypto tokenomics is actually what's like really opened my eyes to a lot of our dollar debasement issues, as you would see cryptocurrencies being thrown off and sold because of their inflation rate, right? And so rather than holding on to those inflationary tokens, what a lot of what Beefy does is it sells off the inflationary tokens to buy more of the underlying assets. Unfortunately, in this case, it's actually buying more of this inflationary token. And so what's actually going to happen is this is going to sell off in dollar terms into more OP, right? So this is actually not that great of a pool, and that's why I only have a limited amount of money exposure to it. And most of the money that was deposited in this pool actually came from OP itself, as an airdrop token. What we got now, so unlike traditional stocks, a lot of crypto is given out for using or being an early adopter of crypto, which is pretty awesome. Imagine if you were an early adopter of a company, and the company said, hey, because you were an early adopter, we're just going to give you some stocks. Well, that's partially how crypto has been working, which is kind of why a lot of young people are in it and making a lot of money, right? So it's fascinating. Now, what's interesting is we could also go back to BTC. We're going to look at all vaults, right? I'm going to pick one of these, a random one, something like this right here. I don't know this platform, so I'm not recommending this, but I'm showing you what I'm showing you about that's unique about this platform is if you look at this, and we want to go to the deposits, right? If you don't have the liquidity for these assets, and let's say you only brought dollars in, you can actually enter this position with dollars. It will buy you exposure to the WBTC, which is wrapped Bitcoin, and Ethereum, allow you to make the 4%, almost 5% on trading fees while being in this position. So if Bitcoin and Ethereum is going up, you're getting the benefit of that. But you're going in with dollars. And then when you want to withdraw, you can withdraw in either Bitcoin or Ethereum, but you can also withdraw in dollars, which in itself is very powerful, right? Now, do realize you do have some risks here. You have risks of the underlying platform, which in this case we said was Swapfish. I know nothing about Swapfish. And you also have the risk of the blockchain that you're on. In this case, it was Arbitrum, which is a second layer blockchain to Ethereum. But with that case, they give you a rating on Beefy on the various platforms. And then you also have the risk of the platform Beefy in itself. But if you look at this, I was talking to somebody else who has a portfolio manager making only about 7% per year. But yet you have these pools that are paying 40, 10, 15, 17, and Bitcoin. Bitcoin has volatility, but like in this case, this pool, which is using curve on convex, is making 9.5%, and it's actually making it in terms of Bitcoin. Now, granted, I do not recommend or endorse putting your Bitcoin into a pool like this, because what you're actually doing is you're actually trading your actual Bitcoin for a derivative of Bitcoin. And obviously, with any derivative asset, there is risks and counterparty risks. In this case, there's 3 different counterparty risks. I don't even know what multi-BTC is. SBTC is a synthetic of Bitcoin through synthetics, and WBTC is a wrapped Bitcoin that is issued by BitGo. So you have to know your counterparty risk when doing a lot of this DeFi stuff, and be comfortable with that risk level. But anyways, I'm showing you where some of the benefits are that people are not aware of. Now, there's also a future. 0% interest rate loans. I was talking to a guy who was a private equity money manager, and I dropped this idea of, well, hey, what about 0% interest loans in DeFi? And he's all, that's impossible. I said, no, it's not. Here's a site. And he's all, well, how the hell is a company making any money? Nobody can do this in our business. And I said, well, no, it's a protocol, right? And he's all, what do you mean a protocol? I'm all like, it's like the internet. You can't shut down the internet. you go and use the internet. You go to the library, use the internet. You know, unless the internet is shut down, this isn't going away. It's like using TCP/IP or using a mail client. It's there, right? Um, and so it's a protocol, and once it's launched on the blockchain, unless you shut down the blockchain or take down the whole internet, it's not going away. And I explained this to actually a congressman, going, there's people in Congress who do not realize the technology that is being built right now, folks, uh, is decentralized. It's amazing. 0% interest rate loans. Let me talk to you a little bit more about this. This is how much value is currently locked in this protocol, right? And it's still early. Using front ends. There are multiple front ends. Well, you could say, well, the government's going to go and shut it down. Well, guess what? There's not one business, right? These are a list of all the different front ends and different companies that are accessing this protocol. And if one were to go down, simply another one could pop up. All right. Why would somebody run a front end? Well, companies get rewarded in the platform token, LQTY, for providing a front end. And they can set the fee. The front end actually sets the origination fee, right? Right now, in the competitive rate of front ends, they're charging only 0.5%. So you want to see how this is done. We're going to go look at this, okay? So we're going to give this example, right? Now, if I only do 10 ETH, and for those who aren't familiar with ETH right now is $1,552, right? So if we only have 10 ETH, and this is the future of collateralized banking with crypto, and why I think we're going to see more people going into crypto because of this technology, right? So somebody deposits their 10 ETH, and I apologize, it keeps going through. And let's say in this case they want to borrow $5,000. All right, it's telling me I don't have enough balance in there. That's fine. The liquidation price of that ETH would have to fall. ETH would have to fall $550 for my loan to get liquidated. All right, because I'm using Ethereum as collateral in this case. They're depositing 10 ETH. There is a liquidation fee of $200. This is going to be debt that has to be paid back in LUSD. You also then have a 0.5% origination fee. This is what is adjusted by the front end. And in a competitive market, people will drop that price, right? This could fluctuate over time, depending on how the front ends want to charge. Right now, that fee is $25. And so we're looking at total, we're going to be taking a loan, in this case, of $5,225, right, to take out $5,000. Now, we're going to look at this and we're going to say, well, that really isn't that great, right? Because if we say, okay, $225 off of 5,000, I'm paying, 4.5%. Okay, nothing great, but as rates go up, that may be incentive for some people. If you're paying for a car loan or you have a credit card, maybe this is a better deal because your payback period is 0%. Now, the trick is here is you actually have to have the crypto collateral up front, right? So there is a little bit of an advantage to the wealthy here. But this also provides a reason to potentially save in crypto. We can see that the collateral ratio here is 297%. Your liquidation ratio starts at 110%. So if you fall below 110% collateral ratio, you will be liquidated. Now, but let's look at a different scenario here. Let's say that you were a wealthy individual and you were able to have 100 ETH, right? In this case, and you wanted to borrow 50,000. All right, that's going to be quite a bit of money in this case. If we go look at ETH was what, $1,500 times 100 ETH, you have $150,000 worth of Ethereum. Let's say you bought that at an affordable price or a cheap price, and by selling it, you may result in a capital gains tax, right? Well, in this case, because you're borrowing and it's a loan, based off of current taxes, there should be no taxes on that, right? On a loan. So in this case, you want to borrow $50,000, right? Again, 100 ETH deposit. Your liquidation price, again, is $550. Liquidation reserve is $200 for the cost of liquidation. and that's what gets paid out to the LQ2Y token holders who provide, mostly earn through the platform providers, the front ends. And then now the fee, because it's a 0.5%, is $250. So we're talking $450 in your cost of the loan. Your total debt created is $50,450.14. Now, if we take $450, divide that by 50,000, and let's say time that by 100, that's only 0.9%. It's less than 1% for the cost of the loan. Your collateral ratio is 307. So for less than 1%, you get to borrow $50,000 that can be paid back at any point. The only difference here is, the only issue with this is the potential for liquidation, right? Eric Voorhees, a guy who's fairly well known in crypto and DeFi, who was early to Ethereum and had a fairly large bag, took a loan out on this platform and bought a house last year. Pretty amazing. If you don't like dollars, there's a similar platform being developed, or that is actually out right now, that is doing Swiss francs. And I'm actually interested to see this move forward. Not only are they allowing Swiss francs and allowing borrowing against Swiss francs, but they are also allowing borrowing against Bitcoin, or wrapped Bitcoin, I should say, which is pretty impressive. So if we go to here and we go click on borrowing, we can see that you can borrow against wrapped Bitcoin or Ethereum, and you take out the currency in a stable coin that is pegged to the Swiss franc. Very interesting. There's a number of platforms that which people actually, where the platforms are earning probably pretty significant fees. And so I recommend taking a look at DeFi Llama and looking at some of those platforms. If we actually scroll over here and we look at this, we can go through and see that there are actually other platforms, and there's actually platforms that are paying their holders revenues. So I want people to understand that there is so much more in DeFi and in crypto that is not being discussed by the financial institutions, and they have a reason to pay congressmen to try to take this down because of the financial freedom that this is providing.